Great. So in terms of the today's agenda, wanted to talk about open interest, which is a very important concept when you talk about futures and options, and also talk about volume and how open interest differs from volume. And then I wanted to show you simple tools where you can do what if analysis if you're taking an options position. You can look at how the open interest is moving. What are some of the other charts that you can see to take a decision? And then in Zerodha, wanted to show you a simple setup which works. Of course, nothing works all the time in stock market, but the setup which I'm going to show has a little high probability of working. So you can check that setup and start doing some paper trading or start trading with smaller quantity till you become confident. And of course, during the course of this program, we will talk about further uh, concepts, more complex things. So slowly you will increase your proficiency. So that's the agenda for today. So just recall what we discussed about futures and options. These are the contracts which is entered. And in a contract, there is a person who writes the contract or called the option seller, and the person who buys that option called option buyer. That is for the option. In a futures contract, simply there is a buyer and a seller. So a buyer and a seller get into a contract for the futures. Option, there is a seller who gives the promise, and there is a buyer who buys that promise or the option. Whenever a contract gets created in the system, that is called the open interest. So if I promise someone that I am going to buy one lot of Nifty from you, that in the system creates one open contract, which is called the open interest. And whenever we square that off, then that is closure of the contract. Okay, so that open interest will become zero. So let's take a simple example. I promise someone to buy 5 lots of Reliance at 2,500 rupees, which means that I am selling a put option to someone, and the person buys that 5 lots of put option from me. This is the first transaction that is happening. So in this particular case, the number of open interest will be 5. Now, some websites will report it as 5. Some websites reported 5 into the quantity of one lot, which is 50 in the case of Nifty. So they may report as 250. So you need to understand when you're looking at the data, that is the data being reported as the lot or per quantity. And that's a minor difference. But essentially, the example I gave you, 5 open interest gets created. Now, after 3 days, the buyer who had bought that contract from me thinks that he no longer needs to hold that, and he can sell it to another person who is willing to buy from him. It's a new person, a third person who comes into the picture. So now the earlier buyer got into a contract with a new buyer and sells, let's say, 3 quantity out of the 5 that he was holding to a new buyer. So now there are 3 players in the market, right? First of all, I was there who sold 5 contract originally. There was a buyer A who bought that 5 contract from me. So there were 5 open interest. Now there is another guy called B who got into the market, who bought 3 contract from the earlier buyer A. So now in the system, I am holding 5 sold contract. Buyer A is holding 2 contracts. Out of that, buyer B is holding 3 contracts. There will be no change in the open interest. Okay, the open interest will continue to be 5. Now what happens? That buyer B sells his 3 contract, which he had bought from buyer A, back to me. And I was the original seller of those 5 contracts. So now buyer B sells it back to me, those 3 contracts. So now what is the situation? Buyer B bought 3, he sold it back to me. he will be holding 0. I had sold 5 contracts, I bought back 3, I will be holding 2. And buyer A will be holding 2 contracts. So now what happened in this scenario? What would be the total number of open contracts in the system?
2. 2.
2.
2.
So the open interest decreased from 5 to 2 in this particular scenario.
So one question, Dheeraj,
Yep.
sorry. When you
Yes.
say the seller first 5 opened the 5 sold 5 contract, so even if there is no buyer, he can sell it.
No. So there has to be a buyer and a seller.
Okay.
There has to be a buyer and a seller. Only then the contract will happen. He can't sold if there is no buyer.
Okay.
But I'll come to that. So let me first complete this. So now this is clear that we started with 5 contracts. Another party came in the market and there was a transaction between the earlier buyer and this new guy who bought from him, and the earlier buyer sold it. That did not make any change in the open interest because there was a new party who came and the existing contract just changed hands. But when the existing contract got closed, we saw a reduction in the open interest. I hope it is clear to everyone. Now, in the stock market, you don't know to whom you are selling, to whom you are buying, etc. Right? That thing is not known. All that is taken care by the exchange. But the key for us to understand is that if a new contract is being created, there is an increase in the open interest. And if an existing contract is squared off between the parties who are already holding the opposing position, then there is a reduction in the open interest. Is that clear? So if there is no new contract getting written, but the existing contract is getting closed, and the way existing contract will get closed is that an existing buyer will, the existing buyer, the person who's holding it, will sell it, and an existing seller will buy it back. I hope it's clear, right? I mean, it's just the total number of contracts. And if an existing contract is getting settled, then the OI will decrease. If there is a new player who's coming and the existing contract is not getting settled, but it is just getting passed on to someone else. Yeah, Satyendra, can you put yourself on mute? Okay, just one second. Then there won't be any change in the open interest. Okay. So I hope that is clear. Otherwise, it will become clear to you as you go along. Now think about it. What does this open interest signify? If there are a lot of the number of open interest for a particular security, for example, Reliance, is high, what does it mean? So we discussed about why there's option, etc. So can you take a, try to answer?
Sir, can I say it is selling at premium, sir?
No, it is selling at, there is a premium, correct? Which will, the option is always, the contract will happen with the premium.
Premium in the sense more than the market value.
Not necessary, right? Because the contract can go up even if there is an expectation of price falling. All you would, any other guess? Anyone else want to say?
And that probably means the stock is active. I mean, it's basically just active and generates interest, right? So
Correct.
it's not like it's going to move somewhere.
Correct.
Liquidity.
Which means that, correct. Yeah, Arvind, the liquidity is high, right? There are a lot of parties who are interested in that particular stock, correct? So in India, if you look at open interest and you want to, now what do we need? I mean, why am I talking about open interest? Because ultimately our objective is to do some trade and make profit. So whatever I'm talking in these sessions has to ultimately be looked at from a goal of making that profit. Yes or no? Right? So the open interest data should be able to tell you something which will help you in making the right trading decision. And if open interest data is not able to tell that, then that particular open interest data is of no use. Agreed? Now, in India, if you look at the Indian market, open interest data is relevant not for every stock which is part of future and options, because many are not very actively traded or the number of open interest will not be high. So in that case, the data can get skewed by a big party getting interested and creating, say, contract and some other people buying from them. Where you should look at this open interest data, particularly if you're trading in the Indian market, is in index options, Nifty, Bank Nifty. Fin Nifty is still at a nascent stage. It is gaining traction. So after some time, I definitely expect OI data for Fin Nifty will also start making sense. Right now, it doesn't give you too much of indication. So you can't take a decision based on OI data for Fin Nifty, but definitely for Nifty and Bank Nifty. And for top 10 liquid stocks like Reliance, ICICI Bank, HDFC Bank, Bajaj Finance. So 10 stocks, the top 10 traded stocks, only those stocks you should look at open interest and make certain decision. Now, how do you look at open interest? What decision you will make? I will talk about it. Okay. Yeah. Raghavendra, you had any comments?
No, sorry.
No problems. Yeah. So that is the concept of open interest. Now, very quickly, I want to discuss about what is volume and how is it different than the open interest. So volume is any transaction that is happening by yourself will create volume. So the example that I gave you earlier, when I said that there were five, sorry, just give me 1 second. I need to put the cable. Sorry. There were 5 open interests that got created. Then we saw that buyer A sold 3 contracts to a new buyer B. Now, in that case, the open interest, there was no change. But if you look at the volume, the first time we traded 5 contracts. So volume was 5. Then the next step, there was 3 contracts that got traded. So volume will become 8, though the open interest will remain 5. In the third transaction, the earlier seller, which was me, bought back 3 contracts from the buyer B. So we saw that how open interest came down from 5 to 2. But the volume will go up by 3. So now in the entire example, the 3 steps that I talked about, open interest started with 5 and ended at 2. Volume will be 10. The first transaction for the 5 contract, second transaction for the 3 contract, for the 2 contract, or sorry, 3 contract, and third transaction for another 3 contracts. So volume will be 11. Okay. It's clear from, right? If there is any question, please ask me.
Dheeraj, one question. Are you assuming that that happens on the same day? Then only it will
Not
reflect in the
really,
volume,
anytime.
right?
No. For given time period, right? So whenever I'm talking about volume, for example, whatever I said, suppose it happened over a 2-day period, assume. Then if you need to answer the question, you say, what was the volume in 2 days? Volume was
Oh,
11.
yeah, that's all. That was my question. It was across, spread across.
Yeah. So now the same thing can happen in 5 minutes.
Okay.
It can happen in 5 minutes also. So in that case, you would say 5-minute volume is 11.
Okay, got it.
But let's say that in this next 5 minutes, nothing happens. Then you will say 5-minute volume is 0.
Mhm.
Right. So whenever we look at any chart or we look at any data in the market, that data is always looked from a perspective of a time frame. We always talk in the context of the time frame. So if you are a day trader, once again, you look at either 5-minute data or 15 minutes data. That is the data which matters to you. If you want to do day trading, which means same day you want to buy and sell or sell and buy. If you are a longer term trader, let's say you want to hold it for 3 days, 4 days, 10 days, you look at a daily or the hourly time frame. And if you're a very long term trader, you even look at a daily and the weekly time frame. So that is how the things work. Market remains open for 6 hours, 15 minutes in India, right? And there are 5 days in a week. There are 4 weeks in a month. So typically all these things work in the multiples of 5, right? So you look at a 5-minute data, 15-minute data, 1 hour data, 1 day data, 1 week data, 1 month data, 1 year data, depending on what is the kind of trading you want to do. Okay. Any other question?
I have one. I might be digressing here, Dheeraj.
Yep.
So volume indicates the number of transactions, but individually at a stock level, they also have something called as a delivery percentage, right?
Correct.
What's the correlation between volume and delivery percentage?
Yeah. So if it is intraday square off, then there won't be any delivery because you bought at 9:15 or 10 o'clock, you squared off at 10:30, same day. There is no delivery, right? It is intraday trade. But if you did not square off that particular thing on intraday, then you have to take delivery in the stock. So that is the delivery percentage. Now, it's a little bit of a digression from what we are discussing, but just to conclude, if you know that the volume is very high, but the delivery percentage is lower, that means it's a very speculative stock. People are just buying and selling, but they don't have the conviction to hold it. But if the stock price is going up with higher volume and higher delivery percentage, that means that people are seeing a value in buying and holding that stock. So as a medium to long-term investor, you should be looking at stocks with a higher delivery percentage rather than a very high volume, but the delivery percentage is very low. Okay, so
Got
that's
it.
the answer.
Is there a magic number to that delivery
There is no
percentage?
magic number. You look at maybe 60-70% above that, but there is no sacrosanct number.
Got
Okay.
it.
Because it depends on percentage is one thing, but what is the overall volume? What is the typical volume for that particular stock? Every stock has a different volume, right? Reliance volume is very different than Kajaria Ceramics volume. Correct? So it has to be relative to that particular stock. What is the typical volume in that stock? What is the current volume? What is the typical delivery percentage in that stock? What is the current delivery percentage? So look from that perspective. Okay.
Got it. Thanks.
Okay. Now, any other questions on open
So
interest?
Dheeraj, one question. I think if you in the internet a couple of months before there is a Hindalco, there was some the issue was there. For example, with respect to the stock that Hindalco, the question is, let us say you bought some option, and when you want to sell before the expiry, there is no let us say seller. Sorry, you want to sell it, but you are not able to square up because there is no buyer probably. So then something happened, and that person probably lost some 15 lakhs or 12 lakhs. I saw that internet. I just I wanted to understand. So if option you bought it, and if there is no seller, then what happens, and how typically to understand that and manage that?
Yes. I had discussed briefly in the previous sessions, but I will just mention. I think for everyone's benefit, what Ajay is talking about is a specific stock option. And as I have mentioned before, the stock options, there is a physical settlement on the day of the expiry, which means if you are supposed to take delivery, then you need to take delivery. And if you're supposed to give delivery, then you should have that share. Doesn't happen in the case of index, it is cash settled. So index, we don't run into this issue, right? Now, in this example, Ajay, I had also talked that how you can take a counter position if possible.
Okay.
Right? So for example, if you were long in the future, you had bought a future, or let's say you had sold a call option and the call option was in the money, which means you had to give the delivery. Correct?
Okay.
Then what you can do is you can so assume take one scenario, right? Assume that you had sold a call option and the call option is in the money, which means you need to give that shares to someone. Okay? And
Okay.
you are not able to square off your call option, which means you are not finding a buyer for your call option.
Right.
Now, if nothing happens, you're not able to do it, then exchange or your broker will have to buy those many shares in an open auction and charge you for, the auction price may be higher than the current price, and broker is going to charge you higher brokerage than usual. So you will have cost implication, plus you should have so much money in your account to buy those many shares, which you may or may not have. So in that case, you will take a counter position, which means that you can, for example, short in futures, which means you will have to give delivery, right? And then the exchange nets it off. So on the call option, you were supposed to give delivery, and in the you will not sell future, you will buy future because you will have to take delivery. So whatever position you had in the call option, you were supposed to give the shares. You buy the futures, which means you need to take the shares. So both will get squared off.
Okay.
Or you will buy because you are not able to buy a call option, you can try to see if you can sell another put option in the money.
Okay.
So these are the two techniques. So you have to take an opposing position. But if you're not able to do that, there will be cost implication for you. Thereby, one should not be very greedy. And if you don't want to take the delivery, you should not keep waiting till the very end to square off.
Okay.
As a best practice, you should not wait.
Okay.
Okay.
Thank you.
Great. So now what do you do with the open interest? I talked about open interest, I talked about volume, but how does it matter? Okay. So before I show you the chart, I wanted you to think and then answer me. We all know when you are buying a particular option, all you need to pay is the premium. So for example, if Nifty is at 18,800, I expect the price will go up. Okay, Nifty is at 18,800. I expect the price will go up. Which option will I buy?
Call.
Call option. If everyone is clear, right? On this call, that if I expect the price to go up, I will buy a call option. So 19,000 call option, suppose I want to buy. 19,000 call option is trading at 15 rupees. And Nifty one lot is 50. So, or let's say for the sake of simplicity, we say that 19,000 call option, the premium is 20 rupees. Okay. And I want to buy one lot of Nifty 19,000 call option. How much money do I need?
1,000.
1,000 rupees, right? 20 into 50. That's all I need.
Correct.
Now, if you want to sell that 19,000 call option, instead of buying, suppose you want to sell the same 19,000 call option, how much money you need? I talked about the margin and all that kind of stuff. You guys remember in my previous session? Som, you remember?
Yes,
Maybe 200 into 50.
It is the margin amount we need to
know the margin, right? So margin typically in this kind of cases will be much higher. You say close to 1,10,000, 15,000. We will see in Zerodha, but it will be not like 1,000 rupees. It will be at least 100 times of that, right? And that margin computation, Prasanna, is not just like it is 18,800, so 200. That is not. It depends on. I had mentioned that how the margin is computed based on the standard
risk factor,
the risk and all that kind of stuff of that particular stock, right? So there are two type of margin. There is a span margin, and there is a exposure margin, and both the margins have to be computed, etc. So there is a computation mechanism. Don't break your head over that. It's okay. How that is computed, don't break it. Your broker will tell how much margin you need, right? And every broker have that, and I'll show you on the screen, right? But the point I'm trying to make is that if you are buying that option, you need only 1,000 rupees. If you're selling that option, you need more than 1 lakh rupees. Correct? So obviously, who is taking more risk?
Seller.
Seller. From this perspective, but also the seller needs more money. Correct? In the account. So typically these sellers who will be able to sell in huge quantity. Let's say who will be able to sell 10,000 contracts of Nifty 19,000 call. Very few people like you and me, correct?
Mostly brokers.
Not the brokers, but institutional players. I mean, brokers won't trade.
Right. Yeah.
The big funds, the hedge funds, etc., right? Institutions, not retail. Who has more knowledge and data and analysis and all that muscle power? The big guy, right? Yes or no? I mean, obviously, the big guy have more knowledge, more data points. They have the whole team who is doing research analysis, etc., correct? And they are taking a big position. So now you see that at 19,000 call option, there's a huge OI, which means the contract is very high, which means someone is writing those contracts. When will you write or sell 19,000 call option? What are you expecting the market to do? When
Market to go down.
You expect a market will not reach that. Basically, it will not never hit by that time.
Both the answers. So one is, yeah, Raju, you expect the market to go down. And even if it goes up, today it is 18,800, even if it goes up, you think it will not breach that 19,000. Correct? Or 19,020 because you are getting 20 rupees. So you think it will not go above that 19,000. Now, you are a retail trader and you have heard OI from me or from wherever, right? And you see that at 19,000 call option, there is a huge OI which is there. What can you do? What sense can you make? You know that for that particular expiry, in which there is a huge call option OI for 19,000, most likely the market is not going to go above 19,000. Correct? Yep.
Yep.
Right? So once you have that information, what can you do? What can be your action? Market is 18,800. You see a big OI at 19,000, which is telling you that the big players in the market are not expecting it to go above 19,000 by, let's say, 8 December. So what will you do with that information?
Sir, then our action should be based on buy the put or sell the call option of the 90,000.
Okay. Yeah, so one is, I think, Prasanna, it was you, right, who said you can also sell if you have that 1 lakh rupees. You can also sell one because the others are selling, right?
Correct.
So that is one. Or you want to be little safer. You can say, look, everyone is expecting it won't go beyond 19,000. Let me play a little safe, even safer than that. So I will sell a 19,200 call option, which may be giving me 8 rupees, but I'm happy with that 8 rupees. At least I will get that 8 rupees. Correct? So you know that there is a resistance at 90,000. The second thing what you can do is, I think you said buy a put, right? That also is possible if you see that the OI is consistently increasing at a very close. Let's say we are 18,800 and 19,000 is still 200 points away. But suppose you see a lot of call open interest getting created at 18,800 itself. Or even interesting, market is at 18,800 and people are writing call option at 18,700. That also happens, right? So let me just rephrase my question. Market is 18,800. You suddenly see that a lot of OI is getting created, which means the OI is increasing at 18,700 call option. Then what do you make out of that data?
So
Is
it
that
looks like market
means
will go down below
market will go
18,700.
down?
Yeah, so which means bigger players are betting on it to go down, right? It is 18,800. You're right. Now, in that case, because market is 18,800 and people are writing call at 18,700, so in that case, so you can buy a put. Why take the risk of selling 18,700 call option, right? And put in a lot more money. You know that market, at least the big players are betting that market is going to go down, and they feel confident writing call option at 18,700 where the market is at 18,800. So they are writing in the money call option. The in the money or out of the money, please remember the concept which I talked in the last session. Correct? So you will buy a put. But if you see that it is 19,000, which is still 200 points away, in that case, so you may write a put option, but may not be the best strategy because the players are still think that it can go up to 19,000, right? Which means there may be some room for it to go further up. And the mood is, while mood is bearish, it is not extremely bearish. Okay. The other thing what you can do is, let's say that market goes up further. I think, who is that channel? Just 1 second. I need to mute. Okay. So suppose market further goes up. This is market was 18,800. We saw a call OI addition at 19,000. Now market goes up to 18,900, 18,950. But that 19,000 call OI is still not coming down. See, what should happen? You have written 19,000 call option. You expected market to go down. Market was at 18,800. Market went up further 150 points. Market is now at 18,950. What would be your reaction? What would be your first reaction? First of all, what will happen to call premium, which was at 20 rupees? We sold that 19,000 call at 20 rupees when the market was 18,800. Now the market is at 18,950. What would be the call option price?
So it will be around 100 to 150.
So it will be definitely above 20.
Right.
Unless, we are very close to the expiry. But you are right, right? It could be 100 rupees. Everyone is getting it. Price went up by 150 points. So call option will become more expensive or cheaper?
Expensive.
It will be more expensive.
More expensive. So now call became more expensive. You had sold call option. Will you be in profit or loss?
Loss.
You're in loss. Now you are afraid. You're worried. How much more loss I'm going to make. What will you do? One is you can pray that it should not go beyond 19,000. Correct. The second thing is, you may say, if you're a smart trader or whatever it is, you may say that let me book my loss and get out. Or there are other strategies. I can do adjustment and all. I'll come to that. But you will get out. Or that would be your tendency. You probably won't even wait till 18,950. As the price starts going up, you may like to get out. But let's say you have not taken that position. You are still watching the market. And you're watching the market. Market has gone up by 150 points. But the OI at 19,000, maybe it has decreased a bit, but not much. There is still significant OI at 19,000. Call option. Then should it give you more confidence that it will not go beyond 19,000 or less confidence?
More confidence.
More confidence, right? It's clear to everyone. Price is going up, but 19,000 call guys are still holding their fort. Correct? So when they're still holding the fort, you should also feel little confident that the big guys are holding their fort, then I can also hold my fort for a while, rather than running away and booking loss. If you had taken a position, if you're not taken a position, now it is 18,950, 19,000 premium is very, very juicy. As Ajay said, it is 100 rupees. You want to throw in your hat, you do it, or you sell 19,200, 300 call option. Okay. So this is how you make sense out of the out of the open interest data, whether call or put. Call open interest gives you up to what market can go up, which is where it will find the resistance. Reverse is put option. Do I again need to take an example of the put option to make it clear, or you guys can just understand that it will be opposite of whatever I said for the call option?
Understood, Dheeraj.
Ajay, you understand because you.
Yeah.
I just want to hear from someone who is relatively new. Sanjit or Shri Kumar or Sagar. I mean, do I need to repeat the same thing with the put option example, or you guys are okay?
Maybe a quick example wouldn't hurt.
Yeah.
That will just clarify it. Yeah.
Okay.
Just solidifies, yes.
Yeah.
Hey, just one question, Dheeraj. So, when you talk about the open interest in that case, so we are talking about the open interest at each level also, right? 1900, 19,100, etc.
Yeah. So Raghavendra, I will be showing the option chain and everything.
Okay.
Yeah, I will be showing that. So Prasanna, that will be clear. Yes, it is at every strike. You will see the
Every
open.
strike, right?
Every
Okay.
strike.
Got it.
Okay.
Got it.
And
Thanks.
that is how you will see, when you look at the open interest, you look at how much open interest is there. Is the open interest going up or down? And what is the rate of change? These are the three things you analyze.
Okay. Which is not the case with the volume, I guess, right? Volume, do we say it
Volume also,
for each strike price also?
volume also is there for every strike price.
Okay. Got it.
Correct.
Thanks.
Volume will also be there. It's just that the volume numbers will be different than the open interest number. The reason I give the example. Okay, I'll quickly, Sagar, take a example. Okay. So let's say that in Nifty is at 18,800 and 18,500 is a lot of put OI. So in this case, again, who creates the OI? Typically the big guys who are confident of writing a put option for 18,500. When will they make loss? If someone has written 18,500 put, when will they make loss? At what level in the market?
When the price goes up.
When the price goes, you have written a put option.
It goes down.
Sorry, down. Put,
If you have written the put, but if you have bought a put, then you will make more money when the market goes down. So in this case, on the expiry, they will lose money only if market is below 18,500. Which means that these players are confident that market will not go below 18,500. So if you see the same behavior, then you need to analyze. So essentially, you look at Nifty open interest and you find that the highest put open interest is at 18,500. Highest call open interest is 19,000, which means big players are saying market will not go below 18,500 and it will not go above 19,000. So let me be in this range of 18,500 to 19,000. Okay. So that is the whole concept. Now let me come to the practical thing. How do you look at it, etc. So you can definitely look at this data. You can look at this data in NSE website, but it's like not so well presented. So I personally have a subscription of two of the products. One is called Sensi Bull. Another is called the OI Pulse. These are the paid subscription I've taken because I use these data very frequently. I like OI Pulse more. It has a lot more features. Challenge with the OI Pulse is that these are all paid. He has not given pretty much nothing as a free version. Whereas Sensible has given a lot of things as a free version for a beginner trader. That is good enough. You don't have to take a paid subscription of Sensible. You can register yourself in Sensible as a just register yourself, and whatever they give it for free itself would be good enough for you to begin with. So let me share my screen and show you both. Okay, so this is the challenge. Does anyone know how do I get out of this? Because I have multiple. Once this control is visible to me, I'm not able to. Does anyone know how do I hide this control? Because to go, I have to go to another tab. Okay, I can bring it down. Okay, thanks. Sorry for that. Okay, are you guys able to hear me? Because there was some internet issue.
Yes.
Okay, so this is Sensible. Okay, Sensible. Okay, where should I put this? Is there any way to minimize this control? Okay, please note this down. Sensible. Okay, and these days this is very popular right now on the social media for all the right or wrong reasons. That's a separate story. So you go to Sensible, you can just take a free. So this version which I'm showing is my wife's account, who does not have a paid subscription. So it's a free subscription, which I'm showing you. So you will have to log in through a broker credentials to see a lot of this data. Okay, let me just clear all the trades. So what do you see here? Is it clear? I will, Sensible is the name of the product. Okay, sensible.com. Once you log in and you connect through your broker, so if you have Zerodha or ICICI Direct, they have the APIs built, and you will be able to do any activity only if you log in through your broker account. Otherwise, you will not see any data. Okay. So once I log in here, let me first show you something called an option chain. Okay. So this is how an option chain looks. What are we looking at? We are looking at option chain of Nifty. Okay. And this expiry you can choose here. So we are looking at option chain for Nifty 8 December expiry. It will change if we say, let's say select 29th December expiry. The data will change. So let me go back to 8 December expiry. Okay. We know the concept of ATM, and I had talked about implied volatility. So the last ATM IV for Nifty was 10.4. India VIX, which is an indication of volatility, we'll talk more on the IV, etc. later, was 13.45, which is lower than its typical range of say 16 to 20. And there are various things. So now let's look at how do you read this option chart, option chain. Okay. On the left side, you see all the data related to calls. On the right, you see the data related to put. And these are the strike. These are all the different strikes which are trading right now for Nifty. And you can stop me anywhere to ask. Now you see this 18,700 in bold. Okay, that is basically the ATM, because Nifty is trading as 18,696. So whatever you see in the bold is the at the money strike. Nearest to 18,696 is 18,700, which you see in the bold. Now, what are the data that you see here? I'm going first, I will cover the call, and the same data will be available for put also. So what is the premium for 18,700? Anyone want to prompt?
112.
112.
Correct. Now, what is this OI in lakh? 52.4 lakh OI. Now, Sensible reports by quantity. So if you look at the number of contracts, it would be 52.4 divided by 50. So about 1 lakh unique contracts are there at 18,700. Okay. What was the OI change on Friday? 404.7%, which means it was a very actively traded contract. And the OI, call OI went up by 404.7%. Okay, right now we will just look at that. Okay, so this is the data that you have available. Okay. Now let's look at the put OI. Put is 87.95 is the premium. The OI is 43.5. So if I just look at the ATM, so if you start your analysis looking at the ATM strike, which in this case is 18,700. Start from there. Okay. As you can say that at ATM, the put contracts is lower, right? It is only the quantity is 43.5, whereas the call is 52.4. So put is lower than the call. And the OI change for the put was 72.7%, whereas OI change for call was 404.7%. Now, only with this data, and this question is to more people who are a little beginner, please answer. What sense are you making out? Is the market bullish or bearish?
Bullish. Bullish. Here it is bullish.
Bullish. Yeah.
Market is bullish.
Yeah.
Everyone is saying market is bullish.
Mm-hmm.
Okay.
Bearish.
Who is saying? Arvind is saying bearish.
No, there is one question. This is open interest. It is buy or sell.
So that is what I described. The open interest means there is one buyer and one seller that creates one open interest.
Okay.
Correct?
So it's 50% then.
Not 50. One contract means one open interest. And for a contract, you need both buyer and a seller.
Okay.
Okay. Now, what I said is, if you were hearing me, the person who writes that or the sells that option takes higher risk, but these are typically bigger institutions with a lot of information, data, etc. So they have higher probability of being right. Higher is all probability. Okay? They have higher probability of being right. So when the open interest is going up, you should think that when the open interest is going up, there are more people who are selling that contract.
Sellers, yeah.
There are more sellers.
Yeah.
So in summary, think that
Bearish.
unless there is a seller who is willing to sell that contract, open interest will not get created. Okay. Now that you have that information, Sadev, that the sellers are more, sellers are the ones who create the open interest.
Mm-hmm.
And you are seeing that the call open interest has gone up by 404%, whereas put open interest has gone up only by 72.7%. And
so it is bearish.
It's bearish now.
Bearish. Correct?
Thank you.
Yeah, bearish.
Okay. Now you look at the OI. Where do you see the highest open interest on the call? Look, just eyeball this particular table, this column.
564%.
No, don't look at the change percent. Just look at the absolute OI. Okay. This column.
88.6, 19,000.
So this is the highest, right? At 19,000 call. Okay. Now eyeball this put. Where do you see the highest? This way, this column on the put, where my cursor is.
18,700.
So pretty much at the ATM itself, and after that you see at 18,600 also 40 lakh contract. At 18,500 also you see 40 lakh contract, which means that, while this is mildly bearish, it is not super bearish, right? Because there are put writers at 18,700, 18,600, 18,500, etc. Correct? So while we said that the mood is bearish, it is not very bearish. It's not super bearish. Is that making sense? Just by looking at this chain.
Yes.
Now, you will also see that at 50 strike, the
Dheeraj,
open interest
uh,
are typically,
I mean, it all depends upon the volumes, right? I mean, if we don't know the volumes, what is there at
no, it doesn't matter
call?
volume. In the case of option, volume doesn't matter so much. Volume matters. I will come to that. But what matters more in the case of option is the open interest.
Okay.
In the case of option, in case of normal share, there is no open interest. So you will look at the volume.
Okay.
Because volume can go up by OI coming down also, right? Which means that the sellers are now getting jittery and they want to square off.
So this 88.6 or the 19,001 which is there for call, that indicates the number of open contracts, right?
Correct.
Okay. So basically, I mean, if you look at beyond 18,700, or the 80.6 or 57.6 or 88.6, these indicate that there are quite a few people who are taken against the market.
Correct. They don't expect market to go beyond.
They don't expect the market to go up. But you also told that, this 43.5 and, 40.9 and 40.6 puts, that by itself is also indicating, saying that it is not completely bearish. Doesn't the volume add up?
No, volume will not give you any information on this. I mean, I will.
Dheeraj,
Volume.
hello,
will,
Dheeraj.
Yep.
Dheeraj, can I add something?
Yeah. Please go ahead.
On volume, when the market opens, the volume is reported as 0. At 9:15, it is reported as 0. And while trading go on, it will increase or it will increase. It is not reported cumulative. Whereas OI is reported, it's a cumulative figure for OI. Or volume is reported as 0 at the start of the trading day.
So, yeah, thanks. So that is peculiar for the options, Raju. See, whatever you're saying, right, for volume is very relevant if you're buying and selling a stock. Okay. For the option, what matters is that, what is happening on this. So OI is not the only information. So you can never take a trade based on only OI. Please understand. So let me recap a bit. First of all, OI is relevant only in the case of Nifty, Bank Nifty, and maybe another 7-8 stocks. That's it. Beyond that, OI data has not so much of significance. Point number one.
Any reason for that statement? Any reason for that statement?
Because they're not very liquid contract, right? So if, let's say, somewhere the OI is only, say, 500, correct? I have some view, I create 100 contract. The percentage change will be 20%, right?
Okay.
Whereas Nifty has 52 lakh OI. How many will I write? 10,000? Right?
Okay.
So one player cannot skew the thing. Whereas the ones which are not traded frequently, one big guy having some interest can turn around the whole data. Okay. So with 10 crore rupees, you can create a huge Y in some counters. With 10 crore rupees, you are a nobody in Nifty.
Understood.
Okay. So that is the reason for that statement. The second thing is, just on the basis of OI, you cannot take a trading decision. OI weightage, you should give only 35-40%. And that is also going down for the simple reason that these days, many retail traders have started selling the option. Earlier, they were buying the option. Now, retail also with money, etc., they sell. For example, personally, I also most of the time sell. I buy also. Most of the time I sell. But I'm not a big institution. I don't have that much of information. So the earlier hypothesis that option sellers do it with a lot of knowledge, a lot of information is slowly becoming not so relevant. So thereby, OI, you should not put, so you look at the OI, but you can't just base your decision on OI. This is the second point I'm making. Okay. Now, what else I wanted to show you? I wanted to show you a few other things. Okay. So the other thing which you should look at it is called put call ratio. So put call ratio is nothing but if I look at what is the put call ratio at 18,700, what is the number of put? 43.5, call is 52.4. Okay. So put call ratio is nothing but 43.5 divided by 52.4. which would be, let's say, about 0.87 or something like that, right? PCR. Okay. So what do you do with the PCR? If it is above 1, which means there are more put in the market than the calls, correct? If it is below 1, which means there are more calls than the put. So above 1 is bullish, right? Or above, below 1 is bearish at a high level. But as we know that if there is too much of bullishness, then some correction happens, right? Market never goes in one direction. So typically in the Nifty, what I've seen, and Komal, you put in, if the OI goes above, if the put call ratio on Nifty goes above 1.35, 1.38, then you should start becoming cautious because there can be a fall in the market because everyone has turned bullish, which means suddenly something will happen. And on the reverse, when the put call ratio becomes 0.65 or below, then there can be a reversal. So that is just opposite play. Komal, what have you observed? I mean, I have looked at 0.65 when it becomes very, very bearish, but that means that now the trend may change. And 1.35, which is very bullish, which also means the trend can reverse.
You are right. You are right. Your observation is right.
Okay. Yeah. So put call ratio, keep it in mind. Put total number of OI at put divided by total number of OI at call is the put call ratio. Greater than 1 is bullish, below 1 is bearish. But if it is too much low, also means that market is overbought or oversold. And in that case, there is a reversal possible. Now, the same thing you can look at in the form of the graph, which is much better visualization. Okay. So this is a simple visualization. Okay. You just go here, you look at analyze, and instead of option change, you just look at open interest. So this is just giving you the bar graph of Y. Red is call, green is put. Okay. So this is very easy to visualize. You see, this is 18,700. 18,700 just on Friday. 4.6 million contracts were written on the call, whereas only 2.1 million contracts were written for the put. This is only Friday data, and this is the cumulative data. Let me look at the weekly expiry, just make it for the current expiry. Okay, so number of calls were 4.2, put was only 1.8 for 8 December expiry on Friday. But if you look at the historic data, this is the cumulative data. Cumulative also, you see that in general, your call is 8.1, sorry, at 18,700, it is 5.2. You can clearly see that the highest call is at 19,000. Okay. Any questions? I mean, is it too much or is it making sense? I mean, I like using this tool because it gives me a very simple visualization.
Neeraj, I have one question.
Yeah.
Most of these big guys actually also do this for hedging purpose, right? So is it a good indicator because they might have hedged it for various reasons?
Yeah, that's fine. I mean, it is an indicator. You, as I said, just give me 1 second. Just give me 1 second. Sorry, there was a call. Sorry. So, Arvind, as I'm saying, there are various reasons why the Y will get built. Okay. But if you look at the Y data, that is one of the indicators. That's not the only indicator. You can still give it 35-40% weightage, particularly which are the more liquid contract like Nifty, etc. It gives you a range. Okay.
Got it.
Okay. Now, now let me show you a setup.
Dheeraj, also this can change in a matter of minutes, right? Typically on expiry day.
Yes. Yeah. So you look at the change. See, what I look at here, I look at Y in conjunction with the premium. Okay. And various other things. So that is what you will develop. But essentially when you are starting, you want to look at the range. It gives you some sort of a range to initiate your position. That's it. But OI change, and OI change is also very important, right? I mean, if you look at the option chain, we look at how the OI is changing, right? OI change percentage. And clearly you can see that the change on the call side is higher than the change on the put side. So no wonder the market was bearish on Friday. Okay. So how do you take a decision? Just on this, you can't take a decision, right? I mean, it is giving you some indication. So let me share one setup, okay? And I'll come back to the what if analysis, okay? This is obviously some other account, but so let's look at Nifty 19,000 call option for 8 December. I'm just adding it. Hope you're able to see my screen. Okay. And what I do is I want to look at the option chart. So just a word here. Typically, we see the stock chart or the Nifty chart. There is also option chart which is available on Zerodha, and it is also available on other brokerage platforms. So when you are trading an option, you, in addition to looking at the underlying chart in this case is Nifty. So you should also look at Nifty. You should definitely look at Nifty chart, but you also look at the option chart. And if you have a pen and paper, please note it down. Even though I will publish this video, it will be good if you try to note it down, whatever I'm going to say. So I'm just trying to show you a simple setup. This works, obviously, disclaimer, nothing will work all the time. So manage your risk properly. Okay. I wanted to show you how do you set up this chart and what are the things. So I will do it in front of you so that it will become clear to you. So I come to studies in Zerodha. I have set up a super trend, something called a super trend. These are indicated. Don't worry how super trend is computed, etc. Right now, just note it down. So you add something called super trend and you change the period to 7 and multiply to 2. Don't worry about, what is 7, what is 2, etc. I will discuss in some other meeting. Just make it 7 and 2. Okay. Then you come to, let me keep the volume for now. Okay. Then I want to add another indicator called OI, open interest. Okay. So now I have added open interest data. I will have to look at, okay, why this open interest is blank. Just one second. Okay. I will just move this up. Okay. So I added open interest. Did you see? That is the second thing I have. So the first indicator I have is super trend, the value 7 and 2. Second indicator I added the open interest. Third indicator I have is volume. Then I again go to studies and I add something called moving average. Okay. And this moving average, what I do is I change the period to 20. Okay. Field close, simple moving average. And what I want to do is, instead of close, I will change it to OI. You see this OI? So I will not put this open interest. Typically, it is created on the candles or on the price candles. I want this open interest on the I want this moving average to be applied on open interest as opposed to being applied on the price. So what I'm doing is I'm keeping the simple moving average as 20. The field, I'm changing it to OI. Okay. And that's it. Now you can see that this red line is the moving average line in the open interest panel. So this is my setup. In fact, let me remove volume. I don't look at volume when I do a selling. So this is my setup, chart setup for option selling. Let me go to the views and let me save this view. Okay. And call it option selling view. Just a disclaimer, this is not the only thing I look at it. Okay. I mean, I do other analysis, but this is a simple thing. So if you're noting it down, we have added 3 studies in Zerodha chart. The first one is a super trend with a value of 7 and 2. The second one is open interest. And the third one is moving average, 20 simple moving average on OI. That is all we have done. These are the indicators. So far, so good. Everyone is able to follow.
How much is the time frame? 5 minutes, 15 minutes?
Yeah. So typically,
Time.
if I want to do intraday, I look at 5 minutes. If I want to keep it positional, I change it to 1 hour. Okay. So let's assume that we wanted to buy and sell on the same day. We will look at a 5-minute chart. Okay. Is that clear to everyone? Everyone is able to follow whatever I'm saying. If not, then you please speak up.
Yes, Dheeraj.
Okay. Now that we have set up, so how do we take a decision? So what are the conditions for us to sell an option? This is our chart. Okay. This is how the chart will look, and the real time this will move, right? So we have used a 5-minute time frame. This is for the intraday buy and sell. You don't want to carry this position. This is just the intraday. So the condition has to be that the super trend, as you can see, super trend has a red line and then the green line. And when the super trend is a red line, these candles are below the super trend. When super trend is green line, the candles are above the super trend. Okay, so super trend indicates, when it is red, it indicates that the price is falling, which is bearish. Now you are an option seller. So if you're an option seller, you want the premium price to go up or go down. This is the option selling setup. Okay, this is not an option buying setup. As an option seller, you want the price to go up or go down. Premium. Premium.
Go down.
Premium should go down.
Go down. Go down.
Go down, right? Because you are selling. So whenever you sell something, you want the price to go down so that you can buy it back and book the profit. So condition number 1, the super trend should be bearish. Okay, super trend should be bearish. That is condition number 1. Oh, okay, sorry. I'm extremely sorry. I need to add one more study. Okay, which is called RSI. Sorry, you please make a change in your note. One more study I need to add. Okay, so I'm adding RSI as one of the studies. And what I did was, in RSI, the period will remain 14, field close, no change in that. What I will do is overbought, I will change to 60, and oversold, I will change it to 40. And let me just change the color for the visualization purpose. Okay, extremely sorry for this. I need one more indicator, RSI indicator. Okay, note down the settings. RSI setting is 14 as the period, field is close, color whatever you can keep, and I'm seeing the zone. Overbought, I've changed it to 60. Oversold, I've changed it to 40. So this is my another indicator. So I had super trend, I had OI, I had simple moving average on OI, and RSI. Okay, these are the indicators I have. So first thing I want in the option selling, that the super trend should be red, which is bearish. The price should be below the super trend. That's the first condition. Second condition is OI should be going up. As you can see in this graph, my second condition is OI is going up. And I'm talking about the entry condition. OI should be going up and OI should be above 20 moving average. So this green line should be above the red line. And the third thing is my RSI should be below 40. This is an option selling setup. Once again, let me repeat. Super trend bearish, which means red line. Prices are below super trend. Condition number 1. Condition number 2, OI is the green line is going up. Condition number 3, the OI is not only going up, but it is above the 20 simple moving average of the OI. Condition number 4, the RSI should be below 40. These are the 4 conditions. And ideally, I should be catching it when that happens rather than jumping in the middle. Okay. So when the market opened at 9:15, I looked at where the OI is getting built, say 19,000, wait for 5-10 minutes, right? At say 9:30, I see that the price is below super trend, OI seems to be going up, RSI is below 40, I will sell this option. I'll sell this option. Okay. When will I buy this option? Oh, sorry, buy it back. Buy it back. If I've sold it, when do I square it off? When do I book the profit? 100% for sure, if the super trend turns bullish, if this red line becomes green line, you have to get out, period. Okay. You can get out before that. You can take some judgment here when the super trend is going above 40. So super trend needs to continuously be below 40. If it is going above 40, you need not wait here. You can still exit because you already were in a good profit, right? But if I was not in good profit, I may still wait a bit, but I will definitely exit if it goes above this super trend line and super trend becomes green. Okay. And the third condition is when the OI starts falling. As you can see, towards the end, this is about 1 o'clock or 12:50, 12:55. The super trend turned positive. You sold this option. Even if you sold here, open was 32 rupees. So you would have sold it at 30 rupees, 32 rupees, and you would have got out at 20 rupees. You would have made 12 rupees profit. Is that clear to everyone? This is a simple setup. Please don't just do this and say that Dheeraj, I made a loss. I will not take any blame or the risk. But observe this setup. Ideally, you should get in somewhere here when this condition is met. Like all the conditions need to be met. So if you see when this super trend flipped, all the conditions were not met. So we had to wait towards the end of the day on Thursday itself, right? This 8th December expiry, 19,000, there was indication that it may fall. Okay. But since you're looking at 5 minutes, it is the intraday play. If you want to hold it, change this to 1 hour. Okay. And if you change the 1 hour, same conditions need to be met, right? We are still not below 40. It is just touching 40, right? This RSI. So for the long hold, it is still a little bit of not a very clear. I will probably not hold this position. I would have booked my profit on Friday itself. Okay. Some other things may show you, right? For example, if I see Nifty monthly expiry, 18,000 put option, right? I'm just showing you just for the illustration purpose. This is Nifty 18,000 put option. What do you see on Nifty 18,000 put option? Monthly expiry, December expiry, right? This, just 1 second. This candle here, okay, which was formed on 22nd November itself. The price, this premium goes below super trend. We can see some OI getting built, and the RSI was touching 40. Maybe next candle you could have taken a position, and if you had taken that position in November for a December expiry, you could have just carried it. You don't have to worry, right? Just carry it. This is 18,000 put option. You would have exited on 2nd December. 2nd December, you would have booked your profit. I will not hold it now. Right now, I am not going to hold 18,000 put option because I already made that profit. Okay. Is this helpful? Is this clear to you guys?
Yeah.
Okay. Now
Yes.
I will show a simple thing. Let me turn back to 5-minute chart. And repeatedly, I'm telling the disclaimer. See, nothing works all the time. So you can't just blindly follow this and say that, I'm doing this. You need to understand the overall market context. You need to know that in case it goes in the loss. How do I do the adjustment? So there are many things. It may show you, and then the next 10 minutes it can flip, and you will end up making loss if your quantity was very big. But this is a good setup. Of many setups, this is a good setup that I have found. Okay. Now let me look at, if I am not an option seller, I'm an option buyer, what should be my setup? So this is the option selling setup. Option buying setup, only one more indicator I will add for option buying. And Raju, that will bring your volume here. Because volume becomes important for an option buying setup, and I'll tell you why. Because suddenly if there is a change in the OI, it is happening with the volume. That means that the sellers are getting scared in the market and they're running away. And that is the time buyers should jump in and pounce on that opportunity. See, buyers can make very good ROI, but they get the opportunity very, very infrequently. And they need to wait for the opportunity. They need to be like a, hunter who can wait for the whole night for one prey. You can't just keep on spraying your bullet as a buyer. So coming back, I added one more indicator for the buying setup. Okay. Everything else remains same. And let me save this view as my option buy view. Okay. Everything else is same. But what I do is, when my condition is different, my condition is that the price should be bullish now. Super trend should be green rather than red. When I was selling, I was looking at red super trend. When I'm buying, I'm looking at green super trend. Okay. The OI should be falling instead of going up, and ideally it should be below this. So let me switch it back to 19,000 chart, 19,000 call chart. Okay. So as a buyer, I just look at the opposite of what I look at as a seller. Okay. Let me check Nifty 18,600 put for December expiry. Go to the chart. Okay. So please note down the conditions. This is not meeting my condition for selling. Sorry, for buying. I am a buyer now. What do I see? Will I buy here? The super trend is red. No, I will not buy here. Super trend has to be green. This is not meeting my condition. Can I look at Nifty 18,800 call option? Okay. Okay. Now this is meeting my first criteria. At 12:55 on 2nd December, it met my first criteria, which was super trend is bullish, which means super trend is green and the candles are above super trend. Then that is the condition number one. Condition number two is my OI needs to start falling and the OI should be below this 20 moving average. Just opposite of the selling setup. OI should be below this 20 moving average. And OI should be falling. So that time it was still uncertain. But when I come later, let's say around 2:15 on 2nd or on 3rd, then I see that the OI is coming down. And my RSI should be above 60. So here my RSI was below 40. Here the RSI has to be above 60. It is kind of touching. It is still not very clear. So I would still be a little hesitant. But the condition should be, so I will not take this trade. Okay. But if it would have been above 60, so RSI should have been below 40 for selling, above 60 for buying. And the volume should be increasing. So I should see higher volume bar. That is the condition. I will buy an option. Otherwise, I will not buy. Any questions? So this is my buying setup. And I showed you earlier my selling setup, option selling setup.
Dheeraj, all the conditions should be met in order to take a trade. That is what your rate.
Yes. When I'm entering the trade, all the conditions should be made, should be met, all the conditions.
Say RSI is between 40 to 60 is not a decision making criteria.
Correct. It is risky. You can do whatever you want, but
It can be go up or come down. That is okay. Got it, sir.
What,
it should
what
be-
about the volume, Dhiraj? What about the volume?
volume should be increasing ideally, or should be good volume, right? So if you can see typical, this is the average volume, right? You can see these bars. Suddenly you see the volume is going up. So this is good for the buyer. For a buyer, the volume should be going up and OI should be going down. So I will talk some other day on the short covering and all that kind of stuff. But when the OI is falling, but the volume is increasing. Raju, to your question, you can see, right? Volume is high, but the OI is falling. What does it mean? It means that the buyers are stronger and the sellers are getting scared. They want to square up their position. So the contracts are closing, but there is a lot of activity, right? So that is the setup. Okay. Yeah, Panchanan, volume should be going up. Don't buy
Okay.
when the volume is low.
Okay.
Nifty volume should be above 500,000 on a 5-minute chart.
Okay.
Okay. So, I mean, these are just, I mean, they keep on changing, but yeah, so that is the setup, and try some trades, paper trades, see how it works. I explained the concept of why, I explained how is it different than volume, and I gave you a setup. I know that, I mean, you can always do a Google and understand what is an RSI and what is all these kind of stuff. But these are the indicators, and I've given you a setup. You can try. Okay. That's it for today.